Hey folks, welcome back to Analyzethis Finance. Let me just directly get to the point. You might have been investing into mutual funds. You might have also been investing into stocks, equity. Generally, what people say 90% of the people in the stock market doesn't make money; they only lose money, and that's true to a certain extent. So today, I'll just want to show how a company is being analyzed. This is kind of an analysis which I do in my POV. Some people might be having different analysis in their perspective. Okay, I always look this into a long-term time frame. So today I have two examples. One is of Indian Hotels. Indian Hotels is the owner of the Taj Group, and Taj Group, you all know, it's a leading hospitality player in the stock market or in the hospitality industry. And see, you know that it's almost 1,06,000 crores their market cap compared to the peers compared to the peer players, Mahindra Holiday, Lemon Tree, they are nothing compared to the Taj Group. It's almost 3 to 4 times bigger than the closest peer. That's a very big advantage in which the Indian hotels are having, because they have been in the hospitality industry for decades, and that's the kind of trust in which they have built within the industry. So this is not a stock recommendation for any companies. I just want to show how a company is being analyzed by me or in general perspective. Okay, I'm not recommending you to buy Indian hotels. We can see that we have a PE of 68 over here, and generally people say the PE above 50 is not great and people call it overvalued, but I would say 68 is reasonably valued and it's not that overvalued in my perspective. I can see over here debt is less than the reserves which we can see over here. And generally what happens with private companies is that a good private company playing in the stock market will be having debt less than the reserves. If something happens to the company, the reserves should be able to clear the debt which they are having. But this doesn't apply in terms of banks, because the entire industry, let it be public bank, let it be private banks, let it be government owned banks, they will be having higher debt values compared to the reserve values, because that's how their business works. But that should not be applicable in terms of other private companies. The debt should always be lesser than the reserves which they are having. That's one of the biggest factors which you have to take in care. Also, when it comes to dividend yield, private companies will be having comparatively lower dividend yields. The companies which are owned by public government partnership will only be having a good dividend yield percentage. Private companies generally doesn't have that kind of a dividend yield perspective. So when you're investing into certain companies, you should not be focusing much on the dividend numbers, because you can see it's 0.23. You should not be focusing much on the dividend yield values. So when we come into the chart, we can see in the last 5 years, the company was giving an amazing rally. And what happened in this last 2-3 months is they had a pretty good correction. And that's good. That's really good for the company, because when you grow too much, it's okay to have a slight pullback, because that's a healthy correction for a company, because it shows that the point in which they are right now is reasonably valued for people to invest in that company. So when we go to the PE ratio, in last 1 year, the PE ratio was at 88, and right now the PE is in 68. The PE of 88 was extremely overvalued. Okay, and right now the PE is at 68. So the recent correction made the company to be reasonable at a discounted rate for people to buy. And again, this is not a stock recommendation of Indian hotels. This is taking as an example for people to understand and people to analyze different companies based on how they are performing. Okay, this applies to HCL, Infosys, Reliance, Jio Financial Services, Adani, everything. So we saw the factor of the market cap over here. Other companies are having very less market cap compared to the Indian hotels. That's the biggest plus point for the Indian hotels. And okay, when coming to the core financials, we can see over here the company is having very positive returns throughout the throughout the many different quarters. And also when we see throughout the years, they are having very positive, healthy returns. Some years they have been they had net loss. That's because they have been investing aggressively into their own expansion. That's why these companies have, I mean, this particular company was having a net loss. See, this year throughout the last 2 years they are having an excellent profit after tax, net profit. The CAGR throughout the different time periods. Let me just explain a concept over here: profit, sales, and stock price. Okay, these three values, to understand the fundamentals of a company and to understand if the company is performing fundamentally good for the multiple throughout the years: profit, sales, and stock price. The growth of these three metrics throughout the time period of 10-year and 5-year and 3-year. These three CAGRs is a very essential number, essential, fundamentally promising number to make you understand if the company is performing fundamentally good for the previous couple of years. And in case of Indian hotels, again, not promoting Indian hotels, but they are having an excellent track record throughout the couple of years. Okay, so the 10-year CAGR, 5-year CAGR, and 3-year CAGR, it's positive. If it's positive, if it's more than 5%, if it's more than 7%, that's very good. Generally, companies are struggling to maintain a positive CAGR in terms of sales, profit, and stock price. If a company is maintaining that on all these three metrics, then it's really good. So that's a very core fundamental thing to be taken in care of while checking, while analyzing a company. Indian hotels are having a operating profit of a really good numbers throughout the last couple of years. That's a healthy sign. Again, okay, I'm not getting more into the numbers because it will be boring. Operating margin percentage is also a really important factor. Also, the employee cost. Certain industries, for example, the hospital, so they might be having the employee cost comparatively higher. Based on different industries, the employee cost and the expenses they will be having is different. In this case, they are having healthy employee cost and healthy expenses throughout the years, and the sales which they are getting throughout the years are very good in order to cover these expenses. Then another thing is cash flow, net cash flow. I'll go to the cash flow part. Again, they are having healthy, good cash flows throughout the years. See, from the operating, we saw on the top part, they are having a profit of 1,900 crores in this year, and they invested almost 1,200 crores of that company. Again, financing. Okay, we'll open the financing part. Okay, so there are dividends, interest paid to the different companies, interest paid for the debt. In certain years, they are having a net cash flow of very good positive number, and in certain years they are having a negative cash flow, but it's okay. This shows a really good, these numbers are showing a promising sign of the future. This is applied for any company that you analyze. Okay, when it comes to shareholding, the promoters mean the actual owners in which they are holding the company. Okay, in this case, Tata Sons, the Tata house is owning this 35% of this particular company. That means reliable to a very certain extent, because they have a really good backing from a Tata group. So basically that was it. And so to show another company, over here we have Adani Wilmar. Again, a large cap company, 32,000 crores. Stock is 26 PE, undervalued. But the main problem is, see the stock price. It is showing as an undervalued company, but still it have wiped off the investor wealth throughout the years. Not a great sign. Again, I am not against Adani or something, but still bringing out fundamental factors of a company. Okay, coming over here, EPS. Even though they have been making profits throughout the previous years, even though they are making profits, but as a person who have put money in the stock market, the money is not growing. It's just falling down. And that's definitely not a good sign. See, I was telling there are many different crucial fundamental factors in terms of sales, profit, and stock CAGR. You can see these numbers are not great numbers. That was the basic comparison to make you understand how a good company and reasonably not well-performing company can be differentiated. This is just my perspective of analyzing a company, and you can do this particular method for different companies. This is how basically people analyze on the very surface scale. People who are putting more than 25 lakhs, 50 lakhs into the company will be doing more analysis into that particular stock. I am not into that level yet, but still, when I get into that level, I'll come with that kind of research. That was it. That was basically analyzing a company in my perspective, and I hope you learned something new from this video. Thank you so much for watching. See you in the next one.